Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. I am thrilled to talk to my guest today, PJ Collins. PJ is a managing director for AB CarVal, responsible for managing investments in consumer loan portfolios. He attended Yale University, where he studied history and played football for the Bulldogs. And since then, he has gone on to have a storied career on Wall Street. He began as a sales trader for Citi. He then moved on to become an executive director at Morgan Stanley and then a managing director at Goldman Sachs prior to joining AB CarVal. For most of his career, he has focused on lending to the consumer, which is a rapidly growing and a rather unique market that many investors have quite a bit of interest in, but little exposure to. And we're going to dig into that quite a bit today. PJ, thanks for joining us.
Thanks for having me.
Before we get into it, what was it like playing for one of the oldest football teams in the world? I mean, I imagine Yale has a very storied culture behind it as it relates to a football.
Yeah, it was awesome. I love football. I love school. And when you play in the Ivy League, you don't have to pick one or the other. And you play in a team with people who are very like-minded, so you can, you don't have to pick it, which is awesome. It's a high-level football, right? I mean, there's several people that get drafted every year, right? So it's the Ivy Leagues. It's not Division, 1 or whatever it's called now, FBS, but it's still high-level football. We're fun. We loved it. And a lot of great guys on the team, some very notable players that I played with. Mike McDaniel was a year behind me. He's the head coach of the Miami Dolphins. One of his assistant coaches, Chandler Henley, played with me. He was another receiver. I played with Eric Johnson, who played in the NFL for several years. And then after that, he married Jessica Simpson.
Oh.
Yeah. I played with Alex Faraday, who started Faraday Brand, the clothing company that everybody wears here.
Yeah.
So a lot of guys like that, just like good, smart, hardworking guys. It's a lot of fun.
That's great. And I have to ask you this. So I know you played with the number 23.
Yeah, I did.
Was that chosen for you, or did you choose that number?
I wore it in high school. I grew up in Chicago, so everybody assumes, oh, it's Michael Jordan. I was also a Notre Dame fan, and I loved Autry Denson in the late 90s, who was a running back at Notre Dame. So it was actually Autry Denson, not Michael Jordan.
Oh, I love that. Well, since then, as we said earlier, you've had a storied career on Wall Street. And, it's really interesting because you've been focused on the consumer for most of your career. And it's not an area that a lot of people associate with investing, because most people think of investing in credit as investing in corporate credit. And, listen, it's been called a lot of things, asset-based finance, specialty consumer finance, specialty finance. Can you just explain what asset-based finance is for our listeners?
Yeah, of course. It's a confusing one because sometimes you just limit it to ABF and it's like, is it asset-based finance, asset-backed finance? Look, it's if you take a step back and you look at just the broader kind of consumer just universe in the U.S., it starts with a need of capital, whether that's a consumer, whether that's a small business. Someone needs capital, and you're going to get it from someplace. Broadly, specialty finance, I'll define as lending activity that takes place outside of the banking sector. And so the people, the entities and companies that are lending money to either the consumer or the small business, we'll just call specialty finance companies. That's kind of ABF broadly. And those specialty finance companies need to raise capital from different places, right? They'll raise equity capital from, VC or private equity sponsors or the public markets. But the debt capital they come from, it needs to come from someplace, right? And so whether it's lending money to those specialty finance companies in order to lend to U.S. consumers, that's one way to do it. Or it could be where we spend a lot of our time in what we define as ABF of purchasing whole loan portfolios, either back books or forward flows, of loans that are originated by those specialty finance companies.
So you're buying large pools of small loans from these companies that are originating the debt in the first place.
Yeah, exactly. We're buying hundreds of thousands of individual loans, again, either in a back book, which is just an existing portfolio, or a forward flow, which is buying X million per month for a set period of time from them.
So these companies originate the debt, you supply the capital. Now, this space has evolved quite a bit. And I was actually thinking about this on the way in. You studied history as an undergrad, and you have had a seat, really a front row seat to this incredibly historic change in capital markets, because this is not how the world always worked. I think of consumer finance. I think of you go to your local bank and you borrow for a mortgage or a home equity loan or whatever it might be. Can you tell us a little bit about how this space has evolved over the last couple of decades?
I started in 2004. I mean, the world was very, very different back then from a financing perspective. And so if you think about it in terms of the consumer lending that we see today in the broader capital markets, it was really just like a handful of companies that did it. And the model was also very, very different. And so back in 2004 is when I started at sales at Citi. It was around, you had some specialty finance companies, as I was talking before, but they funded themselves with on-balance sheet financing. They'd get a warehouse line, just a line of credit from a bank that was secured by the loans they originated. They aggregated them up. That's why we call it warehouse. And then they would securitize, and they would just rinse and repeat that routinely.
So effectively, they're borrowing from banks, they originate the loans, and then they take those loans and securitize them and sell them into the public markets, take that money and pay back the banks.
That's right. And then they hold on to the equity or the residual, and they just keep doing that. And it's on balance sheet financing. And the people that would do that they're still big players today. So think about Ford, right? So what does Ford do? They manufacture and sell cars. Well, they have a huge aspect of their business, which is financing people's ability to buy cars, right? That helps juice their sales. And they have been and still are large players in the financing markets, but they're not funding themselves with private credit, right? It's just a different level. What's happened from 2004 till today is you have different products, different approaches to existing products, or just new products with specialty finance companies that need access to different forms of financing in order to grow and provide a product that consumers need. That's selfishly where private credit step in. There's a huge role for private credit to play because it's not the rinse and repeat traditional model that existed back in 2004 when I started.
And so if we think about these specialty finance companies, they're going out, they're making loans to consumers that really banks used to make loans to. How much of this is these companies stealing market share from bank versus, as you said, creating new products or using new technology in order to reach underserviced part of the market?
I think it's all the above. I think if you just simply start with where banks are and what their footprint are, it's going to skew prime, right? And if you think of it in terms of like the law of large numbers, bank balance sheets are gigantic, right? And so even if they just stop growing, the opening that provides for private credit is enormous. But it's a more complicated story than that. You have different periods of time. So take the last 3 or 4 years, right? Banks got surprised by credit in late 22 and 23. They got surprised by rates during that same period of time. And it forced a lot of them to kind of think, hey, is this really enhancing my overall balance sheet? Is this a product that really makes sense in terms of a wallet share for consumers? And so a lot of them started to pull back. And even if they're not exiting the market, they're stopping the growth that's there. So there's a huge opening.
And so you mentioned point of sale, and we talked about the expansion. Take us through some of the types of loans that these specialty finance companies are making so we get a sense for who's borrowing.
It's a big mix. I think at CarVal, we think of the world in terms of consumer secured, consumer unsecured, resi, commercial, esoteric. And there's a ton of different aspects or sub-verticals that fall under there. So there's obvious ones, right, around residential loans. Okay, check, right? Nothing new there. Auto loans, right? Auto leases, floor plan financing. That would be kind of a version of commercial financing. Home improvement lending, point of sale, BNPL. Then you get into much more esoteric asset classes. So there's a bunch of different flavors of them out there. The big ones everyone's aware of, but as you start to drill down into it, it gets a bit more detailed.
How do you think about protecting yourself or, being selective when it comes to partnering with these firms?
Yeah, I mean, we spend a significant amount of time in underwriting. You kind of start at the high level around underwriting the underwriter, as we talk about it internally, around understanding how do they think about risk? How do they source that risk? How do they underwrite that risk? What risk parameters do they take into account when they're seeing certain things through, we call it the servicing market, but basically collections. And so I think that's another one that we could probably talk a long time about, and I don't want to cut it short or give it justice, but there's a significant amount of time.
Well, tell us about some of the things. How do you judge a partner to know whether you want to go into business with them?
I think, I'd break it out into two components. There's the qualitative and the quantitative. The qualitative really is the kind of filter, right? And so if you just get a sense of, okay, how do you think about the world? How do you source? How do you market? And how do you underwrite? And how do all those different things work together? There's a significant amount of opportunities that we just move on from because it just doesn't make sense. It needs to be a product that for their target borrower makes sense for their target borrower. You want a product that actually can work when everybody wins. You don't want to have something where I win, you lose. That's a bad product. And how they just broadly think about risk of like, okay, what is your model and what levers do you pull based on what you're seeing and how you think in price risk. And then you jump to the quantitative side where we get loan level historical performance info and loan level credit origination info. So think of it around, okay, what loan did you originate back then? What were the credit attributes of that? And what does that look like over time? And then once those loans exist, give me one line item per per loan per month. So we can slice and dice the risk as we see it and analyze it as we see it, not some PDF output that you want us to analyze. And that, as you would imagine, was just a significant amount of time and energy and work that's put in there around evaluating credit trends and how things have moved over time, identifying what we see as the drivers of performance that's there. And then you take a step back and you combine, okay, what do they tell me from a qualitative perspective? Am I seeing it in the data from a quantitative perspective?
Right. So they're telling you that they make certain types of loans and have had certain types of performance around those loans. And you really have to validate that with their history. You don't want to be a newcomer in this space.
That's right. You're looking to validate it. And I think we're going to have our own view, and we get that originators are going to have their own view on performance, right? Not surprisingly, there's typically a bid offer that will exist there. And there's ways for us to address that. But at its core, that bid offer can't be too large. And so that's kind of where we started. And that is a huge kind of vetting process for us.
So this has quickly become one of the hottest topics in finance today and investing today. People are really talking a lot about specialty consumer finance and the excitement of the opportunity. Why do you think investors are so excited about this today?
I think the reason why I've always liked it, and look, CarVal's been doing this 30 plus years. The amount of creativity and white paper, blank space that you have in the space is much, much higher than anyplace else that I found in the markets, right? There is the nature of the transactions are very bespoke. The level of your ability to structure them is very high.
So let's dig into what you mean by that. So when you say structuring, what does that mean? How does the structure of this investment differ from, let's say, buying a corporate bond or investing in a loan?
Yeah, I mean, so right, the main difference is that you're not dealing with one counterparty. That's the obligor, right? The credit here that we analyze isn't one corporate credit. Maybe someone is originating the loan, but when you evaluate the credit, you're talking about hundreds of thousands of line items of actually, consumers at the other end of that transaction. And so that just gives you a lot more levers to play with, right? Because the assets themselves are shorter duration, they're self-amortizing, and their performance is varied. When you think about structure, you can think about, okay, let's see if I can figure out a solution where I'm trying to make X return for my investors. I know the seller is looking to make a certain amount of money from the sale, but I want to incentivize that seller to have an ongoing vested interest in the performance of the loans. And one way that we've done it, and we've done different versions of this, is to have some sort of incremental servicing fee or compensation that the seller can make if we're hitting the returns and the performance on the loans that we underwrote.
I guess one of the questions everyone is probably thinking now is you're focused on the consumer largely. Mm-hmm. What is the state of the consumer today? How do you see the state of the consumer in terms of the health of the consumer?
Yeah. It's. I think this is my favorite thing to talk about that comes up in probably every single meeting, conversation, panel, investor pitch. And look, I think really like the underlying question is, hey, I'm looking at delinquency data out there that is showing that maybe the health of the consumer isn't as robust as it once was and delinquencies drop. Why would I invest in consumer right now? That's kind of the question that everybody has on their minds. And there's a lot to that. So let's start to unpack it, right? So as a starting point, everybody tends to see the Fed data that's put out quarterly that breaks out delinquencies levels by asset class within the broader consumer market. So you see mortgage loans, you see auto loans, you see student loans, you see consumer, you see credit card. And as you look at that and you look at the most recent release, almost every single one of those categories, except mortgages, are going up from a delinquency standpoint, right? So that's starting out as kind of a bad fact pattern. But then you start to dig into it and you say, let's actually look at the fundamentals of what's going on with the U.S. consumer. So the biggest one by far is the U.S. residential market. And the levels there have largely stayed flat and very, very low. And a lot of that is owing to the underwriting changes after the GFC, the Great Financial Crisis, where underwriting for residential mortgages has been much, much more conservative, right? So that's a huge component of the market. And as you see that stable, that's a great fact pattern. Auto loans is next, and there's an increase there, but there's a story behind that. Maybe we can get to that at the end. I don't want to get too sidetracked on it. But then you jump in and you say, okay, fine, let's look at the consumer fundamentals. How are things going? Well, the labor market is the biggest one to talk about. And while perhaps there could be some trouble in the horizon, at least on a spot basis, things aren't looking that bad. And then you start to look at other metrics for the consumer around, okay, let's think debt service coverage ratios in terms of how much money are people making versus how much they have to pay out. It's actually at some of their lowest levels and going down, right? And part of that is because incomes have been going up for quite some time, right? So that's probably not that bad of a fact pattern, right? That's kind of a decent counter to it. Then you look at net worth, which is if not at, it's pretty close to its all-time highs, just given the run-up over the last several years in equity pricing and home pricing. And so all the fundamentals behind the consumer aren't bad. What you have is a mixed picture. Selfishly, from an investing perspective, that's a very interesting investing environment, right? Because if everything's good, everybody's going to be doing it, everyone's going to be chasing it, and there's no kind of credit, there's no edge to be made. In a mixed environment, that's a bit more enticing from an investing perspective.
So what is interesting to you today? You mentioned autos kind of as an interesting space. I'd love to double click on that a little bit and get your thoughts on why that is interesting.
Yeah.
And then maybe some of the places that you do think you're finding some value in today's market.
We're trying to go broadly up in credit. So what does that mean? It would go, higher FICO borrowers. Okay, that's an obvious one. We're looking for some security that's there. So auto loans is one that we find interesting. Some auto platforms, not all auto platforms. There's actually a decent amount of good ones, but some not so good ones. Home improvement, right? Because there's something that's there.
And when you say something, you mean collateral.
There's some collateral that's there, yeah. And then point of sale too. And I think what we're broadly trying to do by up in credit is move up in the U.S. consumer's payment hierarchy, right? When times get tough, you're going to prioritize certain types of things. And if there is collateral behind something or an association with a purchase, so I've got some form of debt that was used to purchase, whether that's a car or to fix my home or to buy this bed or whatever it would be, the association with the purchase is a meaningful differentiator in terms of a debt consolidation loan that doesn't have the utility, right? Ongoing utility as it once had. And so broadly speaking, those are the kind of asset classes that we focused on.
That's great. And one of the other things I want to talk about is just the size of the market. This has historically been thought of as a niche market. Consumer lending broadly is large, but as this continues to come out of the banking system, I mean, where do you see this market going in terms of the size of the market and the size of the opportunity set?
Huge. Is that? Can I stop there?
Yeah.
It's gigantic, right? So I always like talking to investors, and you talk about private credit broadly, and you define it as direct lending and then ABF. And you'd say, okay, one of those markets is 6 trillion and one of it is 1 point something trillion. 9 times out of 10, someone's going to say, well, the direct lending market is the 6 trillion one. And it's not, it's flipped. And I think that's just because the historical lack of attention my ABF market has received over the years. So I'm great to see that that's kind of reversed. But it's a huge market and it touches a consumer in so many different ways. People need to purchase homes. They need to drive cars. You need student loans, right? You need credit cards. You need home improvement loans. There's so many different ways, intangible ways, that touches a consumer. And so it tends to be a lot bigger than you think. And then I think as we now have a growing market, and that's just because there's a growing need for the consumer and our economy grows, it's anchored in the real economy. So for all those different things and asset classes I said, as the economy grows, those things will grow too. And you have specialty finance companies that come into play and come to the market. They need to raise capital differently. Then you have existing players that want to finance themselves in a diversified way. So I think growth isn't the issue. Maybe part of the question is always, but isn't the market getting a lot more competitive? Yeah, it is, but it's also a really, really big market. And so for us, the way that we think about it is maintaining discipline of, okay, which asset classes and sectors do we want to focus on? Which underwriters and platforms do we think are good and have an edge at what they do? And is it something that we can source directly, structure in a bespoke manner that works for us and for our investors? And if the answer is no, then it's just maintaining the discipline to just move on to the next trade.
It's such a compelling investment idea. You have high yields, you have tons of diversification, you have the ability to structure the deals in a unique way, you have collateral behind a lot of this stuff. But clearly it's a very complex investment. And I imagine that you must have seen things go wrong over the course of your career. So I'd love to dig into a little bit about what can go wrong, or a specific example where you've seen something go wrong or one of these deals go bad.
I've seen deals go sideways, definitely. As you take a step back and you think broadly of like, okay, what actually can go wrong or what has gone wrong in these markets and why is that the case? When I think about it, it's really around the amount of equity funding and where it's coming from, right? There was, let's pick on the period from like 2021 to 2023, where you had an influx of newer entrants to the market, a lot of tech-enabled fill in the blank of newer products or newer platforms trying to do existing products.
And these are tech-enabled platforms trying to lend to the consumer, like your online mortgage lenders, for instance.
Yeah, or BNPL or credit card or auto lending or just, someone who's just newer players into the market. Where their money comes from, their seed capital, right? Largely that was a VC type market. there was a presumption during that period of time in 21 to 23, and there's other periods of time, by the way, where this was applicable. Well, let's just focus on this one, the recent one. There's a presumption that they were always able to raise capital. And so that meant that they could just grow, not worry about where the next equity dollar was going to come from, because it'll be there, right? I'll go back to my existing investors, it'll be there. I'll raise my Series B, it'll be there, Series C, and so on and so on. When you're focused on growth, you're less focused on unit economics, which when you look at that now, it seems like a kind of a crazy thing to say, especially as a credit investor. We always, to be clear, care about unit economics, but sometimes the platforms didn't care about unit economics. And so when you think, well, how do things go wrong from a credit perspective and from an equity perspective, I think you have people that don't care about unit economics and they just care about growth. Now, the market in 23 and 24, that just quickly changed. And those days just like, there's one day where everyone woke up and was like, oh, maybe I should care about unit economics. It's like, yeah, no kidding. We've always cared about unit economics. We were hoping you would kind of figure this out too. I'm glad you came to the party.
And so did you see some of those deals in that sense go sideways or not work out in terms of from an investment perspective?
I mean, there's a lot of new companies that aren't around now that existed that weren't able to weather the storm because they didn't have the equity capital built up and they grew too quickly. They had to go to the equity markets to raise more capital. And when that money now said, well, when are you going to become profitable? Or let's even focus at the unit economic level. Like, when is this going to be profitable? And you don't have a good answer for that. You can't raise money. Those companies aren't around anymore.
So how do you avoid that as an investor? What lesson do you take away to make sure that you don't end up in a situation where you have poor unit economics, where you don't have loans that you are performing in the way that you'd like them to perform?
We tend to focus on issuers and platforms that are more mature. And so the criteria we think for that is you've raised a significant amount of equity capital. We focus on like what's your equity runway. Someone doesn't have to go to the market in any time in the near term. Do you have bank financing that is good, stable, low-cost financing? Do you have access to the securitization markets? Either are you active in them or are you in the near term? And if you can paint that picture, then it's really, well, why are these people doing these types of trades? It's a lot of funding diversification and being able to raise equity in a more efficient way to allow them to reinvest and grow more prudently than they had been.
So picking the right partners is critical in this space.
Absolutely.
So it sounds like from your perspective, you want to make sure that you're in business with origination platforms that are not newcomers, that have been around for a while and understand the space. And you would recommend for investors to do the same thing with money managers, invest in money managers who have been in this space and understand it and are not newcomers because, as I said earlier, there's a lot of money chasing this area.
There is. And if you look back when CarVal started in the 80s, the firm has seen a lot of cycles, right? And there will be cycles in the future. And for someone who is in ABF and new and jumping into a space at the wrong time, without the depth of that experience and understanding the consumer at its core, you can really get burned as an investor.
Well, PJ, thank you so much for sitting down and talking with us today. This has been a wonderful conversation. I've learned a lot. I'm sure our listeners have learned a lot. And I just want to thank you for taking the time to join us today.
Thanks for having me.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.